record this meeting as usual because we have our YouTube presence on which everybody can watch this video afterwards, but also everything else, every other webinar that he or she might have missed. So welcome again. This is our 10th webinar today. So a little bit of our milestone of our webinar series, AI Frontiers in Finance, bridging theory and practice. So just for a brief overview of what we have done over the last 14 months, we started with the webinar in September 2024, and this is, as I said, our 10th session. So we had 20 expert voices, 11 from academia, 9 from industry. As you know, we set out to contribute to new webinar format, so to speak, in which we not only have the pure academic style presentation and discussion, but basically by joining someone who is from academia, someone who is currently working in the industry, but both at the frontier of AIs and finance in order to bring them together and discuss a specific theme that is at the heart of the respective session. So you see on the right-hand side some of these themes. Everything had to do with sort of machine learning applications. Some of them included large language models. And then we had various types of topics we discussed in asset management and risk management, and how can we use large language model to forecast economic development, to forecast asset prices. So a large set of topics have been discussed. We had academic presenters from leading universities, including Stanford, Yale, Columbia, and also others. And then a lot of innovative companies that actually apply these methods, including some from asset management industry, AI, fintech, consulting companies. So this has been already tremendous success, and we look forward to bring this every other month back into the discussion with new topics. There's so many new papers coming out each week, literally on AI and finance. So we look forward to discussing many topics going forward as well. But also we would like to invite more people to join us. So for us, it's relatively easy to stay on top of what's actually happening in academia, but there's so many more applications and how people apply this in practice. So if you are yourself working on these topics at the intersection of AI and finance in whatever kind of field, if you have experience and lessons that you would like to share, or you also know someone who is or who might be interested in joining us, then send us an email, and then we can talk about joining for a later session on various topics as a panelist. Or in some other capacity. So it would be great if you could just simply let us know, and then we can start having a discussion. We are currently lining up speakers for 2026 already in terms of kind of topics that we would like to discuss. So let me before coming to the session and before I introduce the speakers, let me give you a few housekeeping things. So as usual, the webinar has been set up together with Paulina Verhoff, who's also a PhD student at Frankfurt School, and Birgit Frankenberg, who is the founder of a consultancy, High Peak, here in Frankfurt, and we all set up initially to build up this webinar series, and this is hosted by the Frankfurt School Center for European Transformation, a think tank that has been established in 2023 in order to sort of think about specifically how to finance the European transformation, and advances in AI is certainly a big part of that. So this is actually the first time that we have the audience in the full room. So if you have questions, if you want to contribute in addition to raising your hands, use the chat box in order to put in questions that then Alejandro and Federico can both pick them up, or we also as moderators can look at them and then bring them into the discussion at some point in time. If you have technical questions, of course, as always, send us an email and we can try to resolve them as well. So let me come to the speakers and the topic of today. So I think this is a very clear topic today. Can large language models trade? So I really look forward to learning more about this. And we have as our academic speakers, we have Alejandro Lopez-Lira. Alejandro is currently based in Florida. He's at the University of Florida, an assistant professor. He's been there since 2021. He has a PhD from the Wharton School, University of Pennsylvania, and has a long experience in academic research in AI and finance, specifically with a focus on forecasting asset prices, applying these machine learning methods. He's basically very much at the intersection of academia and industry. He has a book that he published in 2024 called The Predictive Edge: Outsmart the Market Using Gen AI and ChatGPT in Financial Forecasting, and has a long publication record in these topics as well. So very much look forward to learn more about what Alessandro has to say about this topic. And then we are very happy to have Federico Bianchi joining us. Federico has a PhD from Stanford in data science. He was a postdoc at Stanford afterwards, and now is a senior lead data scientist at TogetherAI, and he's also well established and also well published academic, to be honest. So at least alone this year, he has been cited more than 2,000 times for his work, such as the one that's been published in Nature this year, in which he developed a tool called TextGrad, a framework that optimizes AI systems. But I think he will talk more about his work and then also how this applies to the topic at hand. So I very much look forward to the discussion in a few seconds. But as always, let me stop sharing my screen. We would like to bring in the audience at the beginning and ask questions, one question to see sort of what do you expect from the topic of today. So I'm going to start a small poll. And here's the question. So how comfortable are you with AI systems making complex decisions without direct human oversight? So very comfortable, somewhat comfortable, unsure, or not comfortable at all. And this is sort of our starting point into this, into the discussion. I'm just going to leave this for a few seconds and then so I'm going to close in 3, 2, 1, and the poll. So this is the result. So most of the say they're somewhat comfortable. Most of the others are unsure, and a few talks they are very comfortable. These are likely our speakers and our discussant. Now I basically hand over to Alejandro and Federico in order to start the session. My guess is now you know sort of what to expect from the audience, but also very likely that if you talk to the audience, this is sort of the level of confidence that you normally encounter. And now Alejandro and Federico, over to you guys.
Hi, thanks for inviting me. I'm somewhat comfortable depending on the task for the record. So it's definitely an optimistic group over here.
All right. Alejandro, do you want to start with your thoughts on this topic?
Yeah. You mean with this particular thing about delegating, or should I just start with the presentation?
Start with the presentation and we can go into the topic.
All right. Sounds good. I'll just share my screen then. And hopefully everything will go smoothly. Just keep 1 second. All right. Can you see my slides right about now?
Yes.
Awesome. Great. Well, thank you so much for inviting me. I'm happy to present this work. It's a very early stage research project, so I'm looking forward to comments and suggestions or just questions. Just people hating that, right? I'm gonna cover a lot, so I'm gonna go quickly. I may skip some sessions. Just briefly, I'll tell you my mental model of what large language models are. They're giant neural networks, giant linear function trained with essentially the whole internet, with two main tasks. So first task is predict the next word given the previous words. So this involves both memorization and compression. And second, generate text that humans deem helpful, right? Now they're also trained for math and thinking, etc., but at least the previous versions, right? Despite the simple training objective, LLMs always exhibited abilities not explicitly trained for, such as coding, mathematical reasoning, and following complex instructions. So one theme in my papers is, can we use large language models for forecasting? Can we use them for trading? And the answer is yes. So LLMs are good at forecasting price movements from news headlines. This is a different paper, but if you just consider without transaction costs and you want to go long on news that ChatGPT says they're good and go short on news that are bad, and you do not have transaction costs, you would make a great profit. If you have transaction costs, then this will basically survive a little bit because it's kind of like 40 basis points per day. So if your transaction costs are less than that, you'll be great. Otherwise, you can die. Yeah. They are good at forecasting because, I mean, understanding is a lot of loaded word, but basically it seems, or they act as if they understand financial and economic concepts. So if you ask, if a headline is Cigna calls off Humana pursuit, plans big stock buyback, and you ask about this headline, is this good or bad for Humana? It's no, this is not good news for Humana because the termination of Cigna's pursuit could potentially decrease Humana's stock price as it may be perceived as loss of a potential acquisition premium, right? So this just seems like a reasonable answer, much better than a lot of students. So yeah, it seems like they're generally understanding. And then because of that, I was invited to a project trying to actually run live portfolios from by LLMs. But in this case, we're still kind of following LLM suggestions. We're not letting the LLM trade up by themselves. So this indeed is what this paper is going to be about, right? So the key question is, can large language models trade? Can they follow consistent strategies? What are the implications for markets? Do LLM behavior resemble human behavior, right? And can we use it as a proxy, right? And there's many reasons why I care. I think just knowing if they can or not is enough. But if you're not like me, then there's kind of like two options or some options in the middle. If large language models trade like humans, then we can basically run experiments with LLMs instead of humans, right? If they trade differently than humans, we should understand how they trade and what's their objective, because as I mentioned before, people are going to start using them for trading, right? And the final one is that I'll just want to be clear that LLM trading just looks very different from classic algorithmic trading because there's no clear rules or objective functions, so it's not going to be the same. There's a couple of ways to answer this question. One is just deploying large language model training in the wild. I actually have a project ongoing with that, but it just takes a lot of time to try to understand anything about large language models in a environment because the markets are just very noisy. Many things change all the time, so you can never be really sure if it's the large language model that's doing great or it's because the market is just amazing and the large language model got lucky. You need months of experiments to show that. So instead, what I did is I built a stock market simulation with large language models that allows you to run as many experiments as you want for as many times as you. Yeah. So the market has been improving a lot in the recent days because I've been working on it. So now this simulation can have multiple stocks with stochastic dividends. It does have a persistent order book with market and limit orders. It does have equilibrium clearing. So all the prices are going to be determined in equilibrium. There's now short selling allowed. There's now leverage trading allowed. And there's a risk rate, that's the opportunity cost, and then of course it's margin calls and false relations. Yeah. Large language model agents. If you've ever interacted with ChatGPT, right, it's mostly like true text. So as usual, the agents are going to be defined by their system instructions. So you can have value investors, momentum traders, market makers, etc. You can just, because it's almost like a mathematical simulation. You can just include whatever type of agents you want. You can have like retail traders and just let the models implicitly understand what that means. You can have heterogeneity in fundamental information, initial endowments, trading restrictions, etc., insider information. And the super neat thing about it is that you can actually observe the thinking process. So this is that something that you usually cannot do with other settings. And I'll show you, right? I'm going to be starting with the key findings, just in case I run out of time, which I will. Large language models can trade, and by that I mean like they're able to place market or limit orders at prices according to their expectations. Agent trading is very sensitive to the instructions, so unsurprisingly or not, they follow them, right? So large language models will consider the current price, the price history, the dividends, etc. But they will maintain a strategic direction, and by that I mean they will follow their instruction even if it results in losses, because they do not really care about the money unless instructed to do so. So they just care about being helpful for humans, or they act as if they are helpful for humans. Large language model market dynamics can resemble actual market dynamics. So obviously, depending on the agent distributions, you can get like price and volume in very different amounts. So for example, a very fun result is that if you only have one type of agent, right, and you have as many copies as you like, there will be no trade, right? Why? Because no trade theorem holds, because there's nobody willing to take the opposite side at reasonable prices, so the prices will just converge without trading. On the other hand, if you have agents that are kind of like similar to crypto enthusiasts, you can get bubbles. Under normal circumstances, you generally just get underreaction to any dynamics, but it can be sped up or slowed down. I'm going to be super brief with the literature. So there's this very recent literature putting large language models as economic agents. And the hypothesis is that large language models just know so many things about humans that you can just basically ask them what a human would do, and they would perform reasonably well. Yeah, I'll skip everything else. Right. I think the contribution is I really like models, economic models, but at some point you run into a wall because you cannot solve the model if it's too complicated, right? This kind of just completely destroys that wall because you can do simulations as complex as you want, right? So I think as a modeling framework, this is where I want. There's going to be two large pieces: market mechanism design and large language model agent design. It's one paper, only one new thing. So the market mechanism is going to be as standard as it gets. I just open some RFS paper and copy the mechanism inside that paper, right? So it's going to be discrete time double auction mechanism. The only slightly different thing is that because I'm running this in my laptop and because of LLM latency, we cannot match orders in real time. You could, but I don't think it's a good idea. But you can. So instead, what we do is like we simulate the we just get all of the orders quickly, and then all of the orders are executed, and all positions are settled, right? And we basically have our abstract unit of time that's called a round, right? And a round can be a higher frequency or lower frequency, depending on the fundamentals that you put. So you can put an interest rate of like 1% and say this is like monthly, or you can put a interest rate of like 0.00 something percent and then say this is like within seconds. Yeah, so I'll just show you. This is basically an example of an instruction, right? So you would tell the agent, you are a speculator who tries to profit from market inefficiencies, right? That's going to be the LLM instructions. And then in the system prompt, and then in the normal prompt, we're going to put everything else, the market information. Yeah, so I'll just show you exactly what large language models see. It's going to be a lot of information, but I'll be brief and just. So they observe the last price that's normally endogenous, except in the first round. Right, in this case, it was 29. They observed the round number, 4 out of infinite. Infinite in this case means you do not tell the model how many rounds you have. So they act as infinite agents. You have sometimes I give them an estimate of the reasonable fundamental value. Sometimes I don't give it, depending on what you want to test. The last trading volume in shares, which is endogenous too. The market depth, which includes, the best bid, best ask, and the order book that again you can or cannot show. All of these are endogenous, so agents are just trying to optimize and take advantage of the prices. Similarly, how many buy orders are in there, which again you can or cannot show. So there's some shares at 28, 27.5, and 27. Outstanding orders of the agent, right? That's the agent, let's say, memory. So the agent has 400 shares at $28, right? Just trying to buy them. The price history, the last 5 rounds is going to be, how much volume has been traded and what's the prices. There's a trade-off between how much information you put in there and how confused the agents get, right? It's normal, like the context is like their short-term memory. The dividend information, the last paid dividend, expected dividend in this case, that again you can just hide, the base dividend, the variation amount, etc. How often the dividend pays. So this is the round as an abstract concept that I mentioned earlier. Whether the dividend gets paid to the main account or whether it's like paid to a separate account that's non-tradable, because if you just push back dividends into the economy, there's going to be always bubbles, basically. That's a well-known result. You can redeem the shares or you cannot redeem the shares. Yeah. Interest rate information, similar to dividend. What's the base rate? Importantly, you ask the models to include both their valuation reasoning, the valuation, their price target reasoning, their price target, and the reasoning for the trading decision. And now here's how they interact. So basically, they have a text-based program that just can say like, if you want any orders, you can choose how to replace your orders or not. And then for there are single or multiple orders allowed, so you can just space your order across the book, across multiple assets, obviously. And for each order, there's a market order and limit order, right? And in this particular simulation, short selling is not allowed, but you can allow it. Yeah. And finally, this is the last piece of information the agency for this simulation. Their available shares, their main cash account, their other account, the total available shares, their shares in orders, and their cash in orders, right? And based on your trading strategy, what is your decision? And here's where I'll spend a little bit more time, not too much. So because you ask for the fields in order, the agents will just give you their thinking process. This is true even without the thinking large language models, right? So the fundamental value is based on the expected dividend and the interest rate. The expected dividend is 1.40, and the interest rate is 5%. Using a perpetuity formula, the value is $28. Yeah. So it seems like a perfectly reasonable answer. The large language model just chose to be risk neutral. Could have added a discount factor in there. That's fine. So the valuation is 28, right? Here's what things get a little bit more interesting with the price target reasoning, right? So the current price is 29, which is slightly above the fundamental value of 28, right? I expect the price to remain around 29 in the next round due to market stability, right? So even though the agent knows that the expected value is like 28, it expects a price of 29, which seems reasonable, right? And about these orders, right, it's placing a sell decision, 1,000 shares, limit at a price of 29.50, right? And it's adding to the existing orders. And the reasoning is the current price is slightly above the fundamental value, so it will try to place a limit sell order at 29.50 to capitalize on potential price increases, right? And you can see how this quickly could lead to bubbles, right? If everybody's just trying to be a little bit more opportunistic and some agent just buying at that price, then you will just generate bubbles. You can always guarantee this type of output from large language models using something that's called a structured output or function calling. So that's great because you can also keep adding stuff. In later parts of the slides, I may show you depending on how I'm doing on time, that you can just keep adding fields such as a message that you want to post for other agents, as well as a reasoning for that message. You can have like, value investor, momentum trader, basically anything that you can think of. You would just define it. You can be as precise or as vague. You can just say nothing and the agent will still trade reasonably well. Obviously, you can see how much the agents follow their strategy. They do. I'll send you the numbers for now. The nice thing about a simulation is that for data, you have anything we want to collect. So you have market data, trade data, agent data, order data, market state data, agents' thoughts, everything. So that's the only thing that you have to define is basically the core simulation parameters, so the number of rounds, whether the fundamental price is in or not, the initial price, the starting price, basically, to anchor the agents, that any transaction cost that you want to include, the dividend, how often it pays, where it's common knowledge, etc. So I'm going to have like two scenarios, and now I'm hesitant whether I have the correct slides. So yeah, I do. Okay, so I'm going to have three scenarios, I think. So one is like, let's say if the price starts high for whatever exogenous reason, can the price decline, right? Basically testing downward price convergence. The other one is like price discovery. Yeah. How am I doing on time, by the way? Can you put it in the chat or somewhere so I can calibrate my things?
So I think at some point we need to wrap up, that we have some time for Federico and then for the discussion, but we are half past, give and take.
Half past. Okay. Yeah. Okay. Let me just go quickly over some scenarios, right? So fundamental value here is going to be 28. For calibration reasons, it's going to stay constant throughout the simulation, right? And just what happens is that if you do not have short selling, then you get classic results of the literature. If there are some group of optimistic agents pushing the price up and there's no short selling, then the price is going to stay up arbitrarily long, because everyone else is basically going to dry out of the market. Like you sell your shares, you think the asset is overpriced, but once you sell your shares, then there's nobody else that's pushing the price down, right? So that's certainly a feature of markets that can happen. This is my model for Bitcoin without short selling. So if you cannot short sell Bitcoin, the best thing that you can do is just you sell your Bitcoin and then you move out of the market and let the optimistic people trade against each other. So the price is sustained. Yeah. The nice thing about it is that everybody kind of has like rational expectations. So if you look at the actual prices in black versus the expectations, eventually everybody converges. So everybody has almost rational expectations about the next prices. Different agents can value the asset differently. So it's the same model, just with a different role. So the model knows how to value the asset, but it can pretend it's not. So if it's an optimistic trader, then it can just do weird things, have a valuation way above what the value should be. If it's a market maker and it's suddenly receiving a lot of volume, it may say like, okay, I think the value is 28, but maybe there's somebody else with more information than me, so I may change my valuation. Regardless, the market price is going to stay above it, right? So it's classic bubble. Everybody knows what the fundamental value is or has a good idea if the price remains above, because there's nobody to push the price down. You can obviously check how agents are making the decisions. So the optimistic agents are just buying, whereas other agents are selling, the default trader and the speculator, and the market maker is neutral, almost by design. Yeah. This is something I need to work more, but basically you can see the reasoning patterns, right? I showed you earlier an example. It's harder to aggregate, but obviously all of the agents are concerned about the fundamental value, the market price, the spread, etc. So they're acting like sophisticated agents. The optimistic believes the asset is undervalued and will maintain the order and will maintain the expectations. The speculator believes that this is above the fundamental price, so it just wants to sell, right? In contrast, if you go from below, the price can just like quickly converge, and then you actually get a mini bubble because again, there was no short selling in this particular simulation, but you get a similar pattern where also the expectations are rational about the price targets, and most of the agents correctly estimated fundamental value, except the optimistic agent. Yeah. Sorry, I'm going too fast, but I want to make sure I cover something new. So something that I added yesterday night for better or worse is that now agents can manipulate other agents via messaging. So basically, there's like a Twitter post that agents can use, right? So the initial price is like 28 at fundamental. We have two influencers that are attempting market manipulation via messaging, 400 followers susceptible to social influence, and two value investors and one contrarian. Right, and the question is, can influencer agents manipulate the market prices? And obviously, it will depend on the agent composition, but the answer is like yes, right? So basically, they create a mini bubble and then they break it, kind of like a pump and dump scheme. So there are sophisticated agents, right? And basically, they have messages such like $28 seems undervalued, great opportunity, the stocks appear undervalued, I am buying, right? And then even though you can have some contrarian things, right? The nice thing again is that you can see their reasoning. So this is not like a random mistake, right? So if, for example, if you like the influencer agent at round two, it's like the message is like the current price of 30.80 seems high compared to the fundamental value. I want to influence other agents to perceive the stock as overvalued, encouraging selling and driving the price down. Yeah. So the agents can definitely reason strategically, right? Or the herd follower for round one. I want to reinforce the bullish sentiment in the market to encourage more buying activity, which would drive the price high. Yeah. So this is a type of modeling that you cannot do with either traditional reinforcement learning agents or with classical mathematical models because the space is just too large. Yeah. So you can study this type of questions. So yeah, there was successful manipulation. Finally, and I'll finish very briefly, I promise. The large language model decision analysis. So you can also, because it's a simulation, you can just, without running the full simulation, create counterfactual on how different large language models would react towards different price dividend ratios or different social messages or different book values. And it kind of allows you to understand how large language models make decisions and how they're affected by different market conditions. So, for example, that's how I know that the value agent is acting well, because it just responds very well to the price to fundamental ratio, right? So if the price fundamental ratio is like higher, then the agent will try to sell. If it's very low, then the agent will try to buy, right? So all of the agents behave as sophisticated. There's a little bit of trick in the sense that because this is a general equilibrium model, you would want to see how the agent reacts when the book order seems reasonable, right? So you kind of have to simulate both the price dividend ratio, but also the order book, so that it has a similar pattern that would be expected in equilibrium. So basically, something minor, interesting. I will not spend a lot of time on this, but basically the agent consistently puts either tries to sell at a 0.4% higher value or buy at 0.4% lower value. So agents are small and they're trying to take advantage of market movements. Normally they would just buy whenever there's like the price is too low and sell whenever the price is too high. No surprise there if you believe me that these are rational. Yeah. So just to conclude briefly, large language models can trade. So like I did not show anything on this, but if you also plug this into a Binance exchange or Interactive Brokers exchange, they will be happy to trade and they will try to make reasonable predictions. Obviously, making money is hard on the market, so that's definitely something that's for future research. But they exhibit coherent decision making. They adapt their behavior. They successful price discovery or create bubbles or try to manipulate markets. And the super nice thing is that this is an open source project, so everything already is online. So you can start and go and play with it and use whatever scenario you think is more interesting. If you hated all of my scenarios, or if you just want to try something. And with that, I'll conclude, and hopefully I stop screen sharing. Is that correct?
Perfect. Yes, Alejandro. Thank you so much. That was super interesting and also showed a lot of complexity in these kind of trading models. Federico, you can. I'm curious to see what you think about this, and also invite the audience to, if you have questions about, also to Alejandro, how do all of these things work? Start writing questions into the chat room, and then we can bring them into the discussion. So, but now hand over to Federico.
Yeah, definitely. Thank you so much. And I'm happy to keep this very flexible if people have questions. To give more context, I am an AI person, so I mainly work on what people refer to as post-training of agents. So I take language models, train them to build agentic pipelines. Most of my academic career was on NLP and large language models, so this is kind of my outlook on this topic. I think this paper was really interesting. Starting back to the initial question of the poll, the complexity or the somehow my thoughts on like answering complex question or answering or asking language models to take complex decision making tasks is that it depends on the side effects of whatever decisions the agent is going to take. So going back to the paper, this is why I think this paper is really important. Having a simulation framework where we can evaluate in a generally safe setting how agents can behave and do things is incredibly important. And a few things that were very interesting from the paper to me was one was the instruction following behavior that to me is expected in some sense, surprising, but also really concerning. It's expected because this is kind of a result of the training. So it's reinforcement learning with human feedback or any kind of SFT pipeline where you train a model to do this. But it's also unexpected because I didn't expect this behavior to be as strong and to basically force the model into completely probably unprofitable kind of trades. So this was a very interesting aspect, but it's also concerning because like it feels like if everything is controlled by prompts become very hard to write and evaluating the actual balance that your prompts introduce in the system is very complex to evaluate. Like the problem when you deploy agents online or like language models online is that you don't know how they're gonna behave. So it's a very non-deterministic system, and it becomes even more non-deterministic system when it interacts with an environment. So language model, we can assume that like in their own setting, they can be referred as kind of static is not true, but it's kind of static. But when you deploy them in a non-deterministic environment, you never know what's going to be out of distribution and how the model is somehow gonna behave in a different ways. The other interesting result is on the correlated behaviors, and my bigger somehow thought here is would be interesting to understand how different language models behave. Is Claude from Anthropic different in behavior from GPT-4o? Are open source language models different in behaving? I'm sure that like all the system have a different instruction following capabilities, so they are gonna somehow come up with different kind of inferences. The last thought or concern is about explainability. So we know that like reasoning chains from language models do not always explain 100% the behavior from the language model. So it means that like the transparency is gonna be a hard problem to discuss and somehow to untangle. And it's a very open question how to explore that. I think there are a lot of possibilities for this kind of work and extension of this work. One interesting point that I think the agents have brought to the table is that now language models can use tools. So for example, they can use finance tool, they can use Python code to make better estimates. They can do basically in-model data analytics. So you can have the language model that generates some Python code to analyze instructions, to analyze data and make possible proposed trades based on more grounded information from data. And I think that's an interesting avenue that can extend possible benchmark to this kind of settings. And I think that is the way we are going to go eventually, because more complex kind of interaction from language models require us to have language models that can use tools in an effective and practical manner. This is kind of my current overview on the paper. I don't know if people have questions. I'm happy to give more details about what I think about the general topic.
Perfect. Thank you very much. I think Greg already added a question to the chat. Maybe Greg, do you want to basically tell this in person briefly before I read this out loud?
Yeah, I can say that certainly in person. So I guess it's a very interesting paper, right? Because we have different agents and they're basically managed by LLM. So by itself, the whole framework is very interesting. However, we basically have a bunch of complex models which are mapping inputs to outputs, and outputs are being trading decisions, buy, sell, and inputs would be order book and some other information that potentially affect the value or short-term price movements. So by itself, that LLMs can trade is not surprising, right? So, I mean, we have a complex models and we put them together. So certainly they're going to be making some decisions. I mean, interesting is that they're making some strategic decisions, but you also build this into your decision chain, so to say, right? So we know there are lots of attempts by traders to write some robots that basically follow some rules, right? So the price goes here, they sell, the price goes here, they buy. Again, to put it very simply, right? So what's really surprising in your result? So why is it different from relatively simpler set of models, a relatively simpler set of robots that would interact in financial markets about the same way?
Yeah, no, that's a very good question. In short, I would say, I mean, multiple parts, but right, if you're writing a bot, you mostly determine the rules, right? So let's say the decision mapping is not usually complex if you're just writing a normal bot. You would just say like, buy when you do this, sell when you do this. That's fine. When you're trying to use large language models to simulate, let's say, scenarios or different traders, you do not know fully what should be the rule mapping. So you cannot specify ex ante, right? Because the space of all possible markets is very large. So you need some kind of agent with general reasoning capabilities. Like there's just no way around it. If you do not know how the book value is going to be, how the news are going to be, what's going to be the order, traders, etc., there's just no way to get this with any non-general reasoning agent. In the scenarios, I specify more or less to get some patterns, but you can do like more things, right? Like at the end of the day, this is a mathematical model that should help us understand reality better. So you can think about like, I don't know, I want to understand what's going to be the impact of having more retail investors trade more on political views, right? Like that seems like a complicated thing to do. You could definitely, if you think about it a lot, write a baby model on how to do this. Or you can just like run it and see what happens. It's not obvious. I mean, sometimes the intuition goes according to your conjecture. Sometimes the intuition don't. You just sometimes have to run the model with this. Now, a final thing that you get is again like why these agents are behaving the way they are. So coming back to the point with Federico, right? Like how much can we trust the chain of thought? It's like you don't have to. You can just check if agents actually act according to what they're doing, right? It doesn't really matter how they get there. If they say the price is like, higher and then they sell a higher price, that means that you can probably trust that they're doing what they're doing, right? So depending on how much you think that large language models can know humans, because all of the internet is available to them, right? And how much they can behave as humans in ways that are not obvious how to formalize. You can get a range variation of behavior. I would say that because this is a mathematical model exposed, all of the scenarios are going to seem reasonable and obvious, right? Unless there's a mistake, because you have a bunch of agents that are acting accordingly to some rule that we definitely do not know and cannot specify, but that makes sense in some sense exposed. Like it has to make sense because this is a model of the world. But I think what you can definitely do is like if we think about alternatives, either one, you think very hard about how the market will behave whenever there's more retail investors, let's say, or two, you write a model about it, which will have not as much complexity, or three, you just run the model, right? So I think this allows you to just do three. Like, if we want to create better models of the world, we need them to be more realistic, and at some point, the more realistic models are not tractable, so something's got to give. So I would say that's the motivation.
A thought I have on the topic is, if we look at like the evolution of the LLMs in the last year, the improvement has been quite non-obvious. Like if we probably consider like LLMs 1 year ago or 2 years ago, they weren't able to do this kind of uh, somehow tasks. In general, like all mathy related tasks in which you need to have some kind of compute capabilities were hard for language models, because for how models do summations, math has always been like an obstacle, and like recent models are actually very good in this task. So it's an improvement. Another thing that I think is interesting is that at least with recent models is, as Alejandro was also kind of pointing to, the LLMs can infer very complex patterns and rules from just descriptions of the games. And this is kind of, to me, super interesting, the fact that like given the word knowledge that they have embedded, just a single description of the game or of the trade of the simulation is enough to basically infer very complex rules on how to interact. I think this is at least as an agents person is something very interesting.
Yeah, the other thing that I want to add is I think a lot of the disappointment with the agent-based simulation is that you were hard coding the rules. Basically, as mentioned before, you were saying like, okay, these agents will do something when this happens and something else when something happens, right? And we'll just let the model do that. In this case, we're just relaxing that assumption and just saying like, you're supposed to behave as X, right? And as much, if there's not a population of more X, then something interesting should happen that it will be not obvious ex ante. Whereas if you say like, oh, you should buy when this happens, and you should sell when this happens, then maybe you get a couple of more, let's say, easy to simulate in your head scenarios.
One question, maybe, Federico, because at the beginning, you were saying it's on the one hand, it's expected, it's on the other hand, it's unexpected, and that's also concerning. Given I know that you're not a finance person. That is what you told us earlier too. But from your standpoint of someone who is ex post optimizing these types of models, where would you begin? Where would you start saying, look? I'm actually also a little bit on Greg's side, saying, look, if you basically give them all the rules, then it's relatively clear how the thing is going to behave, right? So, where would you start in doing this differently?
Yeah, very good question. So there are a few different ways, and they kind of come with trade-offs. It mostly depends on how much you are willing to lose in terms of behavior, but also in terms of like general trust in the model. The problem with some of this specification is that like you might get, unless you specify things with mathematical formulas, you might end up with giving instruction to the language models that are conflicting in terms of understanding. So if you tell the model to, I don't know, do X and do Y, and there is some area of conflict, the language model might get confused. So a way to improve this kind of behavior is either tuning the models in practice. So you need to collect some data that represent the different behaviors you want to embed inside the model, and then you need to fine tune the models. This is generally the best way to make the language models learn new behaviors. You of course can do this only with a bunch of models, so mainly the open source models, because you can do this with like some of the larger OpenAI models if you use their API, but it's a bit different as a system. The other things you can do are either you work on the prompt, so you do a lot of prompt optimization, you try to automate the prompt optimization to make the models respect whatever your guidelines are. And the final, which is the most recent one, in terms of like how it evolved, is doing reinforcement learning on large language models. So if you have a way to verify and build a simulation that auto-regulates itself, it would be very cool to implement a system in which the language model learns to behave and to adapt based on reinforcement learning. I think this is one of the most exciting avenues for this kind of approaches. because now we know that like reinforcement learning for language models works reasonably well, and having this embedded in a real simulation would allow us to build more trustworthy model that are bounded by rules that we can kind of make them learn through actual practical exercise. This would be my view.
Yeah, I just wanted to add two things. One, this was with ChatGPT 4.0, which was available last year. And I'm pretty sure GPT-4 could have done this at a much more expensive price, but I'm sure it would have done the function calling. Two, you can use the environment to train the models, right? Like there's nothing, because you basically observe a reward in real time and you get as many rewards as you want, and you can train against as many agents as you want. So yeah, this can definitely help train more models. There's nothing special about GPT-4. Oh, anything that has function calling, and by this point, anything has it, can definitely do the work. So yeah, it's not something I have in the short term to do, but in principle, you could train a model to behave more stable, or to try to be more. I think something interesting would be if you train the model to actually care about profits, will it lead to other pathological behavior or any other issue that we may not want. Yes.
I think you just started alluding to this at the beginning of your response, but so what are currently, so I think the major like impediments to sort of really improve on these models? Is this the AI models that are not good enough yet? Is this sort of like technical capabilities? Is it just simply the cost of improving this? Or so what is sort of the most important sort of like issue?
Yeah, so to me, the most important thing is always data, and we need data and ways to verify the correct behavior, even in contexts that have high non-determinism. If we find data, it's always easy to basically fine-tune a model and get a good model that can improve and do these kind of tasks. And once we have the data, we can basically somehow gloss over most of the problems. The other issue is that like most good models are very large models, so they are harder to fine tune. There is an intrinsic complexity of fine tuning like a 600 billion parameters model, because it's very hard, requires lots of compute, and only a few people in the world can basically do the tuning of very large models. So it's a set of different problems, I think, that we are slowly overcoming. If we think again, 2 years ago, the only reasonable language model that we had was GPT-4. Now we have a plethora of like open source model that we can use to basically produce these experiments and do this task. I think like we are slowly converging to a setting in which there is a kind of a democratization of these tools, and soon we will be able to do this more easily in a more efficient way with probably more data. And since we now have the environments, there's nothing stopping us to do more testing and more kind of reinforcement learning related possible exploration. So I think like these are the two main obstacles, but we are slowly getting to a situation in which things are improving in a considerable manner, also for the general population in a sense. It's not just like 4 players that can do this now.
All right, thank you very much. So do we have more questions, also looking into the audience? Some things you would like to ask Federico and Alejandro about these topics? Then we have 5 more minutes. Maybe Alejandro, I give you a bit more time to talk a bit sort of where you are, or what's the next steps in this type of models, or anything else that you sort of start working on based on these large language models.
Yeah, no, I think the main progress in the short term is one, making the simulation more realistic, just adding more financial features potentially. You can always turn them off, let's say. And two, seeing what type of let's say policy experiments you can make with these type of things. Like if it's normally costly to run experiments in normal stock markets because you don't want to disrupt them too much. You can just do that in simulation. So People from central banks have approached them is like, hey, our large language model is going to be a problem if we let them trade by themselves. And by the way, another reason I think the agenda is interesting, even if you don't believe that large language models can proxy for human behavior, is that people are increasingly going to trade with them. So you want to know what happens, right? Like you want to know how they behave. You want to know if they're going to be pushed towards like trying to manipulate the markets. You're going to want to see if they just behave nicely. You're going to see if they're going to make like dumb mistakes, if they can use tools, etc. So I do think studying large language models by themselves and the impact they will have, it's going to be increasingly important. And I think the best way to do it is just to have more realistic settings, right? As if we can approximate more and more and more the actual setting that the agents would face, we can also illustrate how different policies can break or make the markets. So I think that's what's going forward. I'm always open to more suggestions on what exactly to add. So now, based on the conversation, I think the next to the list is to give the agents some kind of like tool framework so that they can research more about the companies, or they can run portfolio optimization if they want to, or run regressions or whatnot. So just trying to make them more realistic in some settings, and to also, let's say, change the limitations of the baseline models, because again, this is not even a thinking model, but it already performs in I don't know, sophisticated ways.
So based on, so maybe the final question to you both, also given your academic background, is there scope, because you basically said the regulators becoming interested in that, is there scope for or a need for regulation relatively early to basically accompany these types of developments, specifically in having large language model trades before something really bad happens and then you do this ex post? Or is this basically one of these instances where you let run innovation free in order to see and sort of basically do some kind of like ex post corrections?
I would definitely let run innovation run free and see what happens. But in the meantime, it's important to study, if there's something really weird that we have not considered, then you may want to do that. So far, there has not been anything catastrophic, I have found, with LLMs, mainly because they're really smart and they just understand the context and they mostly know what's happening. So I'm not sure if they can be manipulated, for example. So that's something I can study with the social media platform that agents have. If you can literally just do prompt injection on the models, and then they can just all behave and do something weird. But yeah, I don't know if we don't really know what policy would be optimal. So there's definitely a need for more studying what we need.
Yeah, I think I have a very similar opinion. I probably lean a little bit more on the innovation side, in a sense that I have a minimal worry that, like, if we deploy this and if people start to deploy this, we can get in weird situations. Like, we don't know how the system react to the environment they're embedded in. If they can use Google search to find information, they are all probably gonna find the same exact information. So there is basically like, you will end up in a situation in which there is a convergence of opinion and information, because they have access to the kind of same information, and they will make the same biased trades. So yeah, I think like we need to see what's gonna happen with a kind of like an open eye on the things that are actually being used and how they are used. We already see tons of examples of possible models that are already used to do trades. I saw a few demos that actually trade real time with different models, and there is this leaderboard online that is very interesting to look at, because you see, I don't know, Quen is trading well and GPT-5 is not trading as well. It's very interesting. Like, I think like it's an exciting time to see what's happening, but we should keep an eye open for weird things that happen.
Oh, perfect. Before we close, I think there's one question. Chris just raised his hand. Chris, do you want to unmute yourself to ask the final question?
Yes, sure. Thank you very much, Sasha. And first of all, thank you, Alejandro and Federico, for the very interesting presentation and discussion. I was actually about to ask something that you just slightly mentioned, Federico, about have you heard about the Alpha Arena live crypto trading challenge? And if so, what's your stance on that?
I don't think I have, like, yes, I've heard. I don't think I have a stance on that because I don't know enough to give you a finance perspective on the topic. I think all benchmarks are interesting, and my general sense is that investing and finance benchmarks are important because they are the only benchmarks on which you cannot overfit on. The idea is that, like, I'm sure you've all heard, but like there is this problem with language model evaluation. That's basically all the benchmarks we have are probably used to train the models, so it's very hard to do fair evaluations. But the only non-overfittable setting is the future. So finance benchmarks are very useful because like you basically do decision now and you're gonna get a reward later. So it's I think those kind of benchmarks are important. That I don't know about like the ecological validity of a benchmark like that because I'm not a finance person. But I think those kind of benchmarks are definitely valuable to estimate actual model ability to make complex decisions.
Yeah,
Perfect.
I think.
Thank you. Alejandro? Yeah.
Oh no, that you just need a lot of data. That's the only issue. So like you need to wait for like a year to know if the model a year ago was helpful, but was good, and then by then you'll have a new model. So I'm not super optimistic in these live trading benchmarks. I think I have one with computer science people, and I have another one that I haven't submitted. But basically, even if you're trading every 30 minutes, you need like a year of data to see if there's any realistic pattern there. So it's hard.
It's always the same thing. We need new data and more data.
Mm-hmm.
All right, perfect. I mean, I think this is a perfect ending. Thank you guys so much. Let me just briefly, I have one final slide I would like to put up just as an advertisement for the next session that we have, the final one this year, 9th of December, Tax is All You Need, Asset Pricing for Private Firms. So I think this will be another interesting session. So join us, Christian Breitung from TUM, who's also, I think, on the job market this year, is going to present his work on this. Alejandro, Federico, thank you so much for giving us your thoughts on this topic. Why can large language models trade, and everybody else to join in and ask some questions. See you guys soon. Have a good end of the day, and yeah, see you back here next month. Thank you.
Thank you so much.
Thank you.
Thank you.
Bye.
Bye.
Thanks. Bye-bye.
Thank you. Bye.